painful day for gold and silver investors, precious metal mining stock investors, just when we thought we were safe. The Federal Reserve was going into a blackout period. There's a certain period of time before they have their big interest rate announcement where they're not allowed to talk. So we thought we were safe. Maybe we'd see some stability in the gold and silver market, but no. We get clobbered. Gold down almost $40 per ounce from its overnight high. Silver down 4%. Who can we thank for this? How about the Wall Street Journal and our old friends at Goldman Sachs? I'm going to tell you all about it right now. So there's this guy at the Wall Street Journal. His name's Nick Timiraos, and many people refer to him as the Fed Whisperer, like he has some inside line with the Fed. Possibly sometimes when the Fed wants to communicate things to the market, instead of having one of their governors, like my local James Bullard from St. Louis Federal Reserve, they'll instead communicate it indirectly through the Fed Whisperer, Nick Timiraos. And he came out this morning with an article that kind of said, oh, maybe they're going to have to raise rates higher than the market is expecting. Well, thanks a lot, Nick. You ruined the gold, silver, precious metal mining stock party that we've been having over the last couple of weeks, and that basically pulled the rug out from underneath the gold and silver price. Now, it's important to remember one thing, and I mentioned this to you in several previous videos. The price of gold and silver have done very, very well over the last, 3 to 4 weeks? They've gotten into what technical traders refer to as overbought territory, meaning when things get bought, there's a way you can measure whether it's overbought. Maybe the prices run up a little too fast over a short period of time. So many people already thought we were due for a little bit of a pullback. We aren't going to panic. Now, let's move on to our friends at Goldman Sachs, because they had to open their mouth as well. They basically said that they thought the market may be overcompensating, if you will. The market may be not recognizing that the constricting effects of this tight monetary policy from the Federal Reserve, that those effects have already been felt. And that would mean that the Fed would again have to raise rates higher down the road. Both of these things combined have made the dollar go up, made interest rates on the 10-year bond go up. And when that happens, the price of gold and silver go down. And you know what happens when the price of gold and silver go down. Number one, we aren't very happy. Number two, that makes the price of the precious metal mining stocks go down as well. Two more quick things I want to mention. Is the economy already slowing down? We had a headline this morning that says U.S. economic malaise is spreading. The services PMI number that came out signaled a Q4 economic contraction. On a separate note, back to our friends at old Goldman Sachs. Look, they're entitled to their opinion just like anyone else. And people tend to really perk up when they hear Goldman Sachs said something. Don't forget, at the beginning of this year, just 11 short months ago, Goldman Sachs was calling for $2,500 gold right now, and they were wrong about that. So they're wrong on a regular basis. Look, when I look at the big picture, I want to hear what you think about this. But when I look at this from a big picture perspective, what Goldman Sachs says, what Nick Timiraos says, is that really going to have a major impact 6 months, 3 months, 1 month, maybe even 1 day from now? I don't think that it will. I think the underlying fundamental story, thesis, whatever you want to call it, for higher gold and silver prices remains in place. One thing for sure, we are going to find out, and I will be here for you through it all. You are always welcome to join me here in Ron's basement. Right now, you and me together, you're somewhere in the world, I'm here, we'll get through this, and I will look forward to seeing you, yes, you, next time.